Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the markets analysts here at HF Markets. And I'd like to welcome everybody to a webinar topic that we haven't looked at in approximately 2-3 months. So it's something that we haven't been looking at of late. There are specific reasons why we haven't been looking at it. We always listen to requests of traders, and we look at topics which they believe that it's something that can imminently straight away help them with their trading experience and trading success, of course. But today we're going to look at something very different. It's something which some people believe it is appropriate for CFD trading, and some people believe that actually short-term trading is something which is more appropriate. This is what we're going to be looking at as part of today's webinar. We're going to look to determine if swing trading is appropriate, and if it's not appropriate, how can it be made in a way which is appropriate. And today's webinar is not just based on theory. We're not just looking at theories. We're going to be looking at statistics, and we will be looking at a swing trading strategy as well, a very well-known swing trading strategy. So if somebody knows a lot about swing trading and they've done all the theory side of understanding the implications and how to apply swing trading methodologies, that's absolutely fine. What will be very useful for these individuals is actually the second half of the webinar, where in that second half of the webinar, we'll be going step by step in understanding exactly how we can use certain indicators and this specific strategy to determine when to enter trades and when to exit trades and how to do it responsibly. So this is what we're going to be looking at as part of today's topic. Now, before we do that, very quickly, we always do a very quick introduction. The only thing really I want to mention as part of this slide here is, of course, these webinars are here for educational purposes only. Now, I've been a financial advisor for many years, so I know exactly what financial advice is. These webinars are not here, though, to give financial advice. They're here for educational purposes only. If you wish to have independent advice, financial advice, then of course there is many financial advisors out there, and you can very easily get access to it. But today, though, this educational webinar, we're looking to apply and provide as much educational material as possible in order for you to be having the knowledge to be active in the financial trading markets, to be able to achieve your goals with experience, with expertise, and within the risk boundaries which you personally set out. So this is what we're looking to do as part of today's webinar. This is the last slide that we're going to look at before we start looking at actual understanding swing trading, what is swing trading, how you can apply swing trading to your day-to-day trading, and looking at today's strategy, of course. Before we do that, a very quick introduction. Now, some people know me because I've been in the market for 9 to 10 years now. I've been a financial advisor, I've been a market analyst. I have 2 licenses, but nonetheless, I always like to do an introduction. Not that it's important to your trading, but it is important to know a little bit about the individual who's providing you with the information. So a bit about my background. I've been in the market for 10 years. I originally was a financial advisor in London for a company which is known as Platinum. Since then, though, I've moved to Europe, outside of the UK. I hold 2 licenses. I hold a UK-based license and a European-based license, which is known as CISEC Advance. And of course, these webinars are here and concentrate on different methodologies. So we, of course, have approaches to the market, which is based on fundamental analysis. For those more experienced traders, we do even webinars based on advanced trading approaches. So for example, looking at the market dome, looking at delta statistics, looking at cumulative delta. These are very advanced tools which are used within the market, where you can look at where there's slippage, look at where there's a lack of orders, understand at what prices there's real demand, looking at the volume profile, and so on and so forth. For those individuals that have been watching webinars which are more for beginners and individuals which have very little experience, then these are things that you can make a note of and you can research. Because, for example, when I was working as a financial advisor and we were looking at very large institutions and very large trading floors, yes, certain aspects of technical analysis is used, but there's more benefits of technical analysis when being used by somebody that doesn't know a lot about the market. Definitely, of course, fundamental analysis is always used, but what is used a lot is order flow analysis. So this is definitely something, if you do have experience and you've been trading maybe 6 months or 1 year, this is something that you can research, order flow analysis. Now, some of these tools, for example, delta statistics, cumulative delta, order flow books. These are all very well-known tools. Today, though, ladies and gentlemen, we're going to be concentrating on technical analysis. Now, at the end of each webinar, I always do a poll. The last time we did a webinar, I had a poll at the end of the webinar, and I always ask traders what they believe is going to happen within the market. Now, what was the question last week? Last week, the question was, which US index will be the best performing by the end of the week? So a very simple question. There's 3 US indices which are tradable on our platform. We had the NASDAQ, we had the S&P 500, and we had the Dow Jones. The question was, which would be the best performing based on the weekly performance by the end of the week? Now, 50% answered the NASDAQ, 50% answered the Dow Jones. Nobody answered the S&P 500. The correct answer was the NASDAQ, but it was 50-50. Normally, I like to see 100% of traders vote the correct answer. This scenario, though, was one of those occasions where some people got it right, some people didn't get it right. Of course, though, anybody that was looking to trade the upward price movement, of course, whether they're trading the NASDAQ, the S&P 500 or Dow Jones, they all were increasing in value, like also after the opening of the US session yesterday. By the way, ladies and gentlemen, today we have a presentation. We're going to be looking at a lot of charts. We're going to be looking at strategies as well. But I don't want people just to very simply have a pen and paper, be writing notes and watching. Speak to us. Tell us about your experience. Tell us if there's something you're struggling with. If you have questions or there's something you're struggling with, mention it and we'll look at it live on the webinar. So, for example, last week, we had an individual who said he's very well able to determine the trend, but he struggles with timing. And that's something we looked at live as part of the webinar. So if there's something you're struggling with, if there's something you don't understand, or if you have a question, there is an option on the GoToWebinar software to write it down and it comes straight to me. You can already see somebody's asked a question. We'll look at that in a moment. So very first thing that we're going to look at is, of course, what is swing trading? Because we've got individuals that potentially have never traded before, so they need to understand what swing trading is. What you need to understand is that there is, of course, different approaches to the market, and there is thousands and thousands of strategies. For example, the week before last week, we looked at a different strategy known as the EWG strategy, very well known within the market. That's was of an ultra short-term trading strategy. It actually comes under the scalping methodology. Now, there is thousands of strategies, but there isn't thousands of different approaches to the market. So each strategy will fall under a category. So swing trading isn't the strategy. Swing trading is the category of different strategies. There's hundreds and hundreds of different types of strategies that are going to fall under swing trading. So swing trading is the approach. To be part of that category, you have to have certain characteristics, okay? So of course, there's the ultra short-term trading strategy, but under that strategy, for example, could be the EWG strategy, the scalping strategy, and so on and so forth. They all have very different ideas and approaches, but they all have those characteristics that will put it under that approach. So the approach we're looking at today is swing trading. Now, swing trading is a short to medium term approach. Swing trading includes opening trades and keeping trades open between 2 days up to 2 weeks. Now, some people may ask, are we only going to be opening and keeping trades open for that period of time? And to answer that question is, if you're setting a target, and we have to keep in mind when we're looking at swing trading, because it's a short to medium term approach, not like strategies that we've looked at recently where it's a short term approach, we're of course looking at a larger target in terms of profit. Okay, this is actually one of the benefits as well to swing trading. Now, because of that, you're of course going to fall into the 2 days to 2 weeks bracket, should we say. Now, if for whatever reason there's a lot of volatility, could be related to interest rates, could be related to earnings data, whatever it may be, if there's a lot of volatility and maybe within 24 hours is achieved, that's not a negative thing. It doesn't mean that you're trading outside of your approach or outside of your trading plan. What I will say though, ladies and gentlemen, is if you're trading more than 2 weeks, then that can be an issue. Why? Because if you're trading more than 2 weeks, ladies and gentlemen, and you're being charged an overnight fee, and also maybe you have to trade more than 2 weeks because there's probably not enough volatility within the market, then that can be an issue. Because if your overnight fee is building up and building up and building up, and you've still got the same target, and of course if you're going to change the target and put it further away, then you're running the risk of moving into bad habits there. That's something not a lot of professional traders are willing to ever do, unless the intrinsic value of the asset is adjusted for whatever reason, which is again something rarely happening in the market. Then of course there's risk to trading for a longer period. So if you're trading for a longer period, you're actually going on to a different approach. There may be reasons why to do that, but there is other risks which are involved. If you're trading and closing the trade earlier because there was a lot of volatility and it's hitting your targets, that's of course definitely not an issue. If in any case that is an advantage and it's not something that should concern you. I've got 2-3 questions. At the end of this slide, I 100% will look at all of those questions. Swing trading has a larger take profit and a larger stop loss. Now, some people may think to themselves, okay, is that an advantage or is it a disadvantage? Because yes, I'm looking to earn more, but I'm also willing to risk more. And ladies and gentlemen, to answer that is that it all comes down to your reward to risk ratio versus your success rate. Of course, the number one thing which I'm always telling traders is trade responsibly. Now, having a larger stop loss does not mean you're irresponsibly trading. There is actually traders that have what is known as a negative reward to risk ratio. Now, if you have a negative reward to risk ratio, a beginner trader may say to you, well, that's definitely trading irresponsibly and you're going to be an unsuccessful trader. A professional trader, though, will look at the mathematics behind your trading. So if putting a larger and further away stop loss actually results in you having a higher success rate, as long as your P&L is positive at the end of each week, then it's actually something which can be positive. Now, we're not having a small take profit and a large stop loss. Our take profit is going to be in line with our stop loss, and our take profit and stop loss will be in line with our success rate. This is something which is super important, if not even more important than your strategy. Traders will focus on the price swing. Now, I'm going to give you an example of all of these, ladies and gentlemen, including the mathematics around trading, including the price swing. And then, of course, you're going to get a better understanding of it when we actually go straight onto the charts and look at the strategy, because we're going to look at certain requirements in order to obtain a signal to understand when to buy, when to sell, when to potentially put certain targets, if you're going to have multiple targets, and of course your stop loss. In addition to this, we're also going to look at options for pending orders as well. Swing trading relies heavily on technical analysis. Now, technically speaking, traditionally speaking, swing trading solely relies on technical analysis. However, within the market, though, of course, there's definitely advantages. If yes, okay, you're going to largely primarily rely on technical analysis, but also to a lesser extent, also involve fundamental analysis, involve sentimental analysis, and involve order flow analysis as well, especially for those traders which have more experience. Now, moving on to point number 4, one of the key rules of swing trading is following the trend and avoiding predictable points of the market. Predictable take profits, predictable stop losses, and predictable pending orders. Now, the large players within the markets, whether you're looking at banks, institutions, hedge funds, fund managers, trading floors, they know all those predictable areas. They know that as soon as you're going to have a price range and you're going to have a sideways price movement, if they push the market slightly higher, it forms a breakout, you will buy. You'll be sucked into the price movement, and then as the price increases, it's just giving them a better point in the market for them to sell. So I'll give you a very simple example. Let's say, for example, we have people, let's say I have an apartment, I'm looking to sell the apartment, and I'm very simply having multiple people saying, I'll buy the apartment for $100,000 US dollars. And basically, I push the price up in order for me to sell at 120,000 US dollars. The institutions within the market are, of course, doing this. They're not doing it illegally. It's not a bad thing. They're just taking advantage of the orders within the market. It doesn't mean they're making slippage or making false market movements, which are, of course, illegal. If you're making false market orders, slippage, and so on and so forth. So again, as part of today's strategy, we want to look at avoiding those traditional areas within the market that beginner traders tend to be sucked in, and then they enter, the market moves against them, and they get stuck into the trade also because they don't exit the trade. So this is what we're going to look at. Swing traders will look at indicators and think about where professional traders will drive the market. This is something very important as well. Now, as promised, I of course will answer these questions. So I've got 2 questions. The first question is, I can't execute a trade even if I have good winning probability. Now, what do you mean execute a trade? So please elaborate, because it's not a question. So maybe it's something that you've experienced, but elaborate so I can comment on it. What do you mean by I can't execute the trade? The platform's not allowing you to execute the trade. What is the issue? So help me understand, and of course, we'll provide an answer to the question. Let's move on to question number 2. So somebody says, why is swing trading less appropriate to CFDs than short-term trading? To be honest, this is something which is something we should look at as part of a specific slide, and we do have a slide for this. Now, when we're trading CFDs, most people are trading with leverage. We're trading volatile assets, and of course, there's overnight fees. Now, because of this, ladies and gentlemen, many regulators tend to believe that short-term trading is more appropriate. Now, that doesn't necessarily mean it's wrong, but what we can do is use swing trading methodologies, but still trade using short-term trades. But you're just looking at multiple short-term trades, and you're avoiding the limitations of swing trading. And again, this is something that we'll look at as part of the strategy, because we want to look at how to benefit from swing trading, but also how to avoid the limitations of swing trading. I've got another question. I don't know if it's my network, but I cannot hear you. Nobody else has mentioned it, and we have quite a few people on the platform. So on the webinar, so I'm guessing the volume's okay. Maybe exit and enter back in. So swing trader, let's look at an example. Now, this isn't a strategy, okay? But we're just looking at an example, what type of price movement we're looking to enter in and take advantage of. So here we've got a trend. Now, when we're looking at short-term trading, we are looking, of course, at the longer-term price movement. This is gold on a 2-hour time frame. We, of course, do care that the price is moving upwards here and that we're having a retracement, a continuation of the trend. We, of course, care about this, but we're entering and exiting, entering and exiting, entering and exiting, and we're continuously doing this. This is, for example, using the EWG approach. We can use the scaling in and out approach, in which case, for example, you enter. You're not exiting any of these trades, enter, and then you're exiting again and again and again. So there's different approaches. These are short-term approaches. What are we looking though when we're looking at swing trading? Now, this is what is known as the price swing. This is also known as a price swing. This is also known as a price swing. So these are two swings within the market. The swing in favor of the trend, doesn't matter if it's an upward trend or a downward trend. The trend is an upward trend because we have higher highs and we have higher lows as well. So we're definitely looking at an upward trend. The impulse wave is the larger price movement, the larger swing in favor of the trend. So for example, if I measure from here to here, and then I measure from here to here, of course, this swing here will be the larger swing, and it's in favor of the trend. So this is the impulse wave, okay? So this is the impulse wave, and the smaller waves which are against the trend, like here and here, and also here as well. This retracement actually got slightly larger over the past 24 hours. These are the correcting swings. Now, there's larger advantages to solely concentrating on the impulse waves and not attempting to trade, at least until you gain some more experience at the correcting waves. Why? Because very simply, ladies and gentlemen, you'll want to take advantage over the larger price movements. Now, if we were trading using short term, then this is quite a large price movement. There's lots of time and lots of volatility there for us to take advantage of. But when we trade in the swing and we're looking to take advantage and keep the trade open for 2 days, 3 days, 4 days, maybe even 5 days, depending on the volatility in the asset, and our willingness to also trade out retracements, then of course this type of volatility here, is not going to be enough. So we're only solely concentrated on the swing in favor of the trend, so the impulse wave. Now here we've got an upward price movement of 3.11%. So you can really understand here what I mean by we're looking to earn higher profits per trade. Definitely depending as well on our success rate. But you could have looked at, for example, this swing, in which case you're looking at a 2-day trade. You could look at this swing, in which case you're looking at a 2-day trade again. You could have been looking at the whole larger swing like this, in which case we're looking at a 4-day trend. If you're going to do so, though, we have to, of course, be willing to hold our nerve and outlive the retracement. We're going to look at these as part of the swing strategy approach as well. And then we've got a 3-day impulse wave here. So again, this is why I'm referring and advising everybody that it's, you know, looking at when we're looking at swing trading, we're looking at that bracket. Okay, it's not up for argument, it's not investment advice, it is fact. If you're looking at the swing trading approach, you're looking at this bracket in terms of its period. So let's continue to move on. Now we're going to look at the benefits and advantages. This is a big factor, ladies and gentlemen. We're going to look at the benefits and disadvantages, and then we're actually going to go straight to looking at the strategy, which is probably one of the most important things as part of this slide as well. Now, the benefits, ladies and gentlemen, is going to answer a lot of difficulties which people find as well. I've got another question. I'll quickly answer this question. So I've got somebody who says, what does the EWG strategy stand for? To be honest, it's just a strategy that we've looked at in previous webinars. He says it's his first webinar. Keep in mind, every single webinar has a different topic. We look at many different strategies. Some people, of course, either I spoke to somebody on a one-on-one session this morning who says, you know, I'm using this strategy on the 2-hour, and I'm using a different strategy from a different webinar on the 5 minutes, and I'm incorporating the two together to form my own personal way of looking at the market. So again, this is why we have different strategies. This is just one of the strategies out of the hundreds of strategies we've probably looked at over the past 7 months or so. So again, hopefully that answers the question. It's not the strategy we're looking at today. So benefits. A lot of people, again, tell me on so many occasions, you know, I can identify the trend. I'm happily able to say, I believe over the next 3 weeks, the price will increase in value. It's not something that I find difficult. I have a lot of traders that tell me that. They say to me, my issue is in the shorter term, I struggle to identify at which price, which time I should enter and exit. So the shorter term volatility and the shorter term timing is the issue within while I'm trading. So the benefit to swing trading, because it's not ultra short term, it's not short term either, it's short to medium term, is that the timing is less important. If your analysis for how the price is going to move over the next 5 days is correct, the timing is not as important. The approach allows for more volatility against the trade. So a lot of people have, for example, experience, let's say, for example, we get an impulse wave, we get the retracement, people wait for the correction above here. So as it corrects above here like this, the trade actually does this. And then it hits they close the trade, it hits their stop loss. But then after that, it actually does something like this. So the advantage of also swing trading is that it allows for larger volatility, whereas when you're looking at short term, ultra short term, it's not something that you can actually take into consideration. Your trading plan is easier to manage. Of course, when you're looking at swing trading, you're trying to earn more per trade and you're trading less. So when you're looking at ultra short term trading, especially the strategy we looked at throughout the month of April, you're looking, ladies and gentlemen, at potentially opening 20 to 40 trades a day. So, of course, your trading plan is taking a lot more data and a lot more statistics into consideration. Whereas when you're looking at swing trading, actually, you may be opening 1 to 2 trades per week. You may be opening maybe 3 to 4, maybe 5 trades per week. It depends on how many assets you are trading as well. Now, in regards to that, a quick note also is one of the biggest advantages, and something which can be very advantageous to traders, especially traders which are learning, is only trade one asset. You know, some people, they look for the $1 million strategy. They look at how the market works, fundamental analysis. They look at so many advanced factors within the market. But also when you're a beginner and you're learning and you're trading, there is actually a lot of advantages to only trading one asset. That's such an important thing. If somebody's looking at Bloomberg, where so many analysts and strategy experts actually go and are interviewed by Bloomberg, you will notice it's a market analyst for the Euro USD, market analyst for the NASDAQ, and so on and so forth. They're not trading a million different assets. They have one person which is an expert for one asset. So when you're learning, there's benefits only trading one asset because you are only concentrate on that asset, your experience, your knowledge, your understanding of its volatility, its traditional price movement, its traditional value, its domino effect, and what's influencing the asset, that knowledge is going to significantly improve much faster. A clearer reward to risk ratio. This is also something we looked at, which is part of the trading plan. Somebody who doesn't understand how to create a trading plan, take into consideration reward to risk ratios, then of course there is also very important and advantages to looking at the webinar, which is based on trading plans. But also we're going to look at this at the very end of the webinar. Requires less time when trading each day, can benefit from short and long-term profits as well. Now, what are the disadvantages? Also, I've got another question. We'll look at it in a minute. Now, what are the disadvantages? Our disadvantages, ladies and gentlemen, is that there is something which is known as overnight risk. So there may be a trend today. Overnight, something very different may happen. Tomorrow morning, it's a completely different scenario, different signals, different price conditions, different volatility, momentum. There is that risk. You have weekend risk as well. So the exact same, but referring to over the weekend. Abrupt changes as a result of news. Okay, you cannot trade for a whole week and expect nothing to be released which is influencing the asset. Can on time profits, of course, because you're looking at a profit and take profit which is further away. Overnight fees, rollover fees or swap fees, whatever you prefer. What I will say in regards to this is there is also an option to limit this. For example, if you believe your trade is going to be open or it's normally open for 3 to 4 days, look at first what the overnight fee is going to be. And you look at your overnight fee and you're saying, for example, you know, if my overnight fee for keeping it open for 4 days is going to be 10 euros and my take profit is going to be 15 euros, there's no point in opening that trade. If the fee is going to be 10 euros and my profit is going to be 65 euros, then that's something which is more understandable. Also, what you need to take into consideration is what is the overnight fee and what is the spread? Because if the spread is much cheaper than the overnight fee, then there may be a better option to very simply close the trade just before midnight, reopen the exact trade after midnight. That way, you're not going to incur any overnight fee at all. And in addition to this, also there may be an advantage if the market gap is in your favor. Definitely a big advantage there, especially if it's quite a large market gap in your favor. And of course, you're avoiding overnight fees. The only thing that you have to be cautious of is that the spread isn't an issue because you're opening a new trade with a new spread. So that's the only thing you need to be cautious about. The last disadvantage is that if there's not enough volatility to hit your take profit and you're actually just keeping the trade open for longer and longer and longer, and the swap fees again being charged and again being charged, in which case you're not hitting your take profit and the fees becoming higher. So that's something we need to manage, and today's strategies can ensure that we're avoiding that risk. Now let's quickly answer the question. So somebody and gentleman who at first said, I can't execute a trade even if I have a good winning probability. I meant to say that I find some hesitation to buy and sell in the market, especially when I see opportunity. Now, first things first, if you've got a good winning probability and you're hesitant to open trades, I wouldn't say that's a big issue. As you become more experienced, it's something which is going to solve itself. The only thing that you should be concentrating on is the fact that you've got a strong winning success rate, should we say. So this is point number one. If that's not what you're referring to in terms of winning probability, then the issue is the strategy. What you want to try and do is avoid the emotional side of trading. So sentimental analysis is the analysis of your personal emotions. It's looking at the sentiment within the market towards a certain asset. It's looking at the risk appetite of the market and how it's going to affect the market. But when you're trading, if you're using a strategy like we're going to look at now, or if you're looking at, generally speaking, technical analysis, it is in no way, shape, or form looking at emotions or hesitations. It is an indicator, and based on that indication, you trade. You either trade or you don't trade. There's no emotions behind it. And to be honest, if the strategy is going to be accurate, and for your P&L at the end of the week and in the end of the month to be accurate, you should be opening all of those strategies, all of those indications. Because if you know this strategy has a 70% success rate, you're going to put your reward to risk ratio based on that. If you're not opening half of those trades, actually it may not have a 70% success rate and it may have a 60% success rate, just because you're not opening those trades, in which case it may throw off your reward to risk ratio. So hopefully that answers that question. Very quickly, ladies and gentlemen, let's have a poll. Very quickly, so I've just launched a poll. I will only allow 1 minute for people to answer the poll. So what do you think is the biggest benefit? So there's 3 options: allowance of more time and volatility, the trading plan, and benefiting from short and medium term trades. So these are the options, ladies and gentlemen. We only have 26% of our viewers have answered the question. Let's see if we can get more people answering. Only 15 seconds left. Ten seconds. Very interesting, actually, because I can see the results. Okay, let's end the poll there, ladies and gentlemen. We have 70% of people answered. So we have the least popular was, to be honest, all of these are benefits, as mentioned. So there's no correct answer or incorrect, but it's what people think what is for them going to be the biggest benefit of swing trading, which is why, of course, they're watching the webinar. So the least popular was the trading plan, 11%. The second most popular, so the second place, is the allowance of more time and volatility, 32%, so quite a lot of people there. The most popular was 58%, which is benefiting from short and long-term trades. Now, a very big benefit, to be honest, is of course the allowance of more time and volatility. But I'm very happy people answered the benefiting from short and medium-term trades simultaneously, because this is what today's strategy largely concentrates on as well. So I'm very glad people answered this. So we've been speaking now, ladies and gentlemen. How long have we been speaking for? We've been speaking now for 38 minutes. And of course, we haven't looked at strategy yet. But people, hopefully, in this 38 minutes, have understood what swing trading is, what's the idea behind it is, what the advantages, disadvantages, what issues it's trying to solve, and what benefits it allows the trader. But of course, we need to look at the strategy, especially because a lot of people, by the way, mentioned emotions as part of their questions. And generally speaking, traders always look at emotions, keep asking about it throughout our webinars in 2024. So swing trading, because it allows volatility and movement against the market and against your trade, it's not such a big issue, and you can give the market time and relax about it. So it helps a lot in terms of emotions. Point number 2 is that it takes emotions out of your decisions, because it's not like, for example, when we looked at back in February, we looked at sentimental analysis and we paired it with fundamental analysis, where it's not a trigger. The trigger is now. It's not $1 above, $1 below. This is the trigger. You either take it or leave it. You know, fundamental and sentimental analysis is really thinking about the market, debating with yourself, evaluating what the real value is, and so on and so forth. So this is going to massively help as well. What type of time frame is good for swing trading? 1 hour, 2 hour, 3 hour, the 4 hour, even slightly untraditional time frames, such as the 6 hour is very helpful. The 8 hours is very helpful as well. So straight away, let's start looking at today's signals and today's strategy. So today's strategy, swing trading strategy, we've got 4 indicators on our chart under 2 categories. This is the first step, of course. Here, ladies and gentlemen, we have a 75-bar exponential moving average, and I've written it down here for everybody. The yellow here, ladies and gentlemen, is an 8-bar simple moving average. Now, people have an option. If they want a slightly delayed signal, they can have an 8-bar simple moving average. A lot of people, most people as well, I'll say most people, not just a lot of people, they prefer the 8-bar exponential moving average. On this time frame though, on this asset, I've got the simple moving average. But on the other time frames, I'm actually using exponential. So the 8-bar, you have an option of simple or exponential. Now, the red line here, ladies and gentlemen, is a 14-bar simple moving average. Now, the 75-bar and the 14-bar is very strictly exponential and simple. It's only the 8-bar where you've got the option between simple and exponential. So we've got the blue 75, the red, which is 14, the yellow, which is 8. Then we've got the relative strength index, ladies and gentlemen. We're looking at 3 areas, 75, 50, and 25 as well. Now, what's the first step, ladies and gentlemen? We want to take advantage of the swings. In addition to this, a lot of people ask, somebody hasn't asked it yet, I don't believe, I can see more questions. Somebody hasn't asked it yet. A lot of people say, when we're looking at swing trading, which swing is the best to trade? Now, there's not a straightforward answer to this, ladies and gentlemen, but the most difficult swing to be trading is the first swing, this swing here. Now, why is this the most difficult? Very simply, ladies and gentlemen, because in order to trade that, you have to determine that the price is going to move, that a trend is going to form before the price movement has even taken place. So we may be looking at a downward trend, and I need to sit and say there's going to be a change in the trend, and there's going to be a trend form that doesn't currently exist. Whereas when we're looking at this price movement, the trend already exists. It's just about saying as this is declining, it's a retracement, it's not a correction, it's not a different trend, it's still a bullish trend. But as it's declining, how much momentum upward do I need to see in order for there to be a trigger that the upward trend now is going to continue? And the same applies to the third impulse wave. So the most disadvantageous is the first, and after the second and third, then of course there's higher disadvantages, because you're starting to get into an area of, you know, the pattern can't continue forever. People will start to cash out. If it's a downward trend, a lot of people are going to be tempted to enter at a discounted price. So of course there's more risk to trading for the fourth wave and above, and there's more risk to trade in the first impulse wave. There's a lot of advantages to trading the second impulse wave and the third impulse wave, ladies and gentlemen. And actually, if you go onto the charts, you will actually see that on the fourth impulse wave on gold, it's there where we saw a lot of volatility downwards. So there's reasons why I'm saying everything that I say, of course. So how do we trigger? What's the first step? Now, because we're trading above the 75-bar exponential moving average, we're only looking at upward trends. We of course want the RSI to be between 50 and 75. We don't want it to be above 75 when we're opening trades. We don't want it to be below 50 when we're opening trades as well. Now, what do we want to see? Okay, we want to see that there is an upward crossover. So we have an upward crossover here, we have an upward crossover here, and we also have an upward crossover here. So ladies and gentlemen, the period of between the 8th to the 20th, we have two signals. So in just under 2 weeks, in 12 days, we have 3 signals. Now, only 2 of those signals, though, are in accordance to our strategy, something that we can use. Why? Because when this crossover happens here, okay, we're below the 75 bar exponential moving average. Also, when the crossover happens, ladies and gentlemen, we're below the 50 on the RSI. So we have one indication that that price movement is going to increase upwards. What indication is that? Very simply, the crossover. So the yellow has crossed above the red. So the 8 has crossed above the 14 EMA. In addition to this, we have a breakout. So you can see this is the breakout point. We have a breakout, so that's a second signal. But we've also got 2 signals that buyers are not controlling the market. So this signals, of course, number 1, we're below the 75 bar exponential moving average, and we're below the 50 on the RSI. So that is not a signal based on the strategy. But of course, the price did move upwards. And normally, as soon as this trend starts for the very first time, like it does there, normally you will get half signals, half conflicting signals, in which case you won't enter. Let's look at the next. So we weren't able to take advantage of this swing. Let's look at the next swing. So this is the next upward impulse wave. All right. So we have tick number 1, upward impulse wave. Tick number 2, we're above the 75 bar exponential moving average. Now, if we go down here, we can see we're also above the 50 on the RSI. So we have managed to get the 3 requirements as the first step. So this has happened within the market. Of course, we're avoiding this. I'm not looking at this. I don't know that this upward trend has happened. Okay, so a good thing is to take your hand and put it, ladies and gentlemen, over just after the crossover, because that's all you're going to be able to see. You're just looking at a slight upward price movement and saying, all right, guys, that looks quite weak. I'm not really looking to enter there. But again, this is what we're trying to do. We want to trade the swing. If we're going to wait for such a large price movement, we're not going to be able to have enough time and enough volatility to enter, earn a large profit, and then exit before the trend and the swing loses momentum. Because if we're only going to make a small profit, it's going to throw us out of the swing trading approach, and it's going to throw us out of our reward to risk ratio compared to our success rate. So keep in mind, you will only see a slight tick upwards, you will get an upward crossover, but it's imperative that we have the bullish crossover. We're trading above the 75 bar exponential moving average, and we're above 50 on the RSI. Then we're going to move over to point number 2, step number 2. We've now switched over to a 30-minute time frame. We're going to look at multiple entries and exits. So it's not medium term, it's short to medium term, multiple entries and exits. So you're also able to take advantage of both short and medium term profits. So now, ladies and gentlemen, what are we looking, of course, to do? We still want to see a bullish crossover on the 30 minutes. So, of course, we want to see a bullish crossover. We want to be above the 50 on the RSI, and we want to be above the price to be above the 75 bar exponential moving average. That will probably be the case on 80% of the time. On the 20% that is not, then that's not a signal. Or you at least need more volatility until the signal becomes active and materializes. So this is step number 1 of step number 2. Step number 2 of 2 is very simply, what are we looking to do? I've got a red line here. At the exact time, we got a signal during step number 1. So this is step number 1. We can see where the signal is. The signal was here. Okay, so I've drawn the exact line where we got the signal. So what am I looking to do now, ladies and gentlemen? I'm going to use the high. So I've drawn a line here. You can see this line. So this is the high, ladies and gentlemen. So very simply, this is the resistance point. This is the breakout level. So you can use it, refer to it as the high, the resistance, the breakout level, whichever is absolutely fine. Now, what am I doing that for? Because most of the time when we get a crossover, the retracement will follow very quickly afterwards. We want to avoid the retracement. There's no point trading at the retracement, especially if it's going to involve us keeping the trade open overnight, and it's going to end up us being charged a swap fee for no reason. And you can see at the time we got a crossover, a retracement does form. Okay, so this is a 30-minute time frame. We have 1, 2, 3, 4, 5, 6, 7. So we're looking at 3.5 to 4 hours of a retracement. Why do you want to be there in 4 hours while the market moves against you? So what I do is I've drawn a line here. This is the breakout point. How am I drawing this line? It's very simple. We've got that impulse wave. I've drawn a line at the high. Okay, if it breaks above here, so at that point I'm entering the market. So that's the impulse wave, and then here we can see this is where we break above. As soon as we break above, so at that point we're entering the market. So this is where we enter the first trade. Okay, this is step number 2. This is where we enter the first trade, and also this is where we will put our pending order. Now stop loss will be very far away. We're going to look at where potentially we're going to be putting our stop loss in a moment. So, ladies and gentlemen, step number 3. Okay, what are we going to do is step number 3. We're looking at a lot of lines here, but it may look complicated. It's not complicated. So what have I done? So this line here is where I entered my first trade. Okay, very simple. Sorry, this is where the first signal happened, the first crossover happened. Okay, so that's where the first crossover happened. Where my signal was actually on this candlestick here. So what am I doing in the meantime? I've got the Fibonacci retracement zones. So what are Fibonacci? How am I drawing the Fibonacci retracement zones? This is the high of the previous swing. This is the low of the retracement. So I'm using these two areas to draw the Fibonacci levels. So as I draw the Fibonacci levels, these white lines appear. So I've already entered my first trade. My first trade, ladies and gentlemen, was entered here at this white line. How do I determine a further 2 trades? And keep in mind, it doesn't mean you have to increase exposure. You can use this to increase exposure, option number 1. If you're slightly more risk averse, what you can do is, instead of opening 3 lots in 1 trade, you can very simply open 3 trades, 3 prices, 1 lot each. Okay, for example. Or very simply, you can look at the fact you're opening 3 trades as an opportunity to open more trades, more exposure, more volatility. Depends on your risk approach, but you have to keep that in mind in terms of your reward to risk ratio and success rates. There's no point doing so if you're suddenly becoming irresponsible and you're going to wipe out your account. That's definitely something we don't want to see happen. Then where we're going to open our next trade. So we've drawn our Fibonacci zones. On the Fibonacci zones, you will see there's numbers here. So we've got 0, 23.6, 38.2, 50, 65, 100, 125, 165, and so on and so forth. So you'll see many numbers appear. We've opened our first trade here, okay, because it's the breakout. Most likely it will be in and around 23.8. Now our next trade, we will put a pending order at the 50 and at the 65 here. All right. Now the first 2 trades, okay, you've got an option here. If you're risk averse, and there's nothing wrong with being risk averse, if you want a high success rate, you don't want to risk too much. Very simply, what you're going to do is that your first trade here and your second trade here, you're going to aim for this take profit. Okay. The take profit is at the 100 level here. Now, your third trade here, you will aim for 125. All right, this is if you're risk averse. Now, if you're not risk averse and you want to max your profits where possible, very simply, your 23.6, you will aim for the 100 mark, the 50, you will aim for the 125, and the 65, you will aim for 125 as well. So you can see this strategy, ladies and gentlemen, is helping you to trade all the way from here and take advantage all the way to the price movement, all the way up to here. So there's only a little price movement after that that you could have taken advantage of. So here again, you can see how useful this would have been. A lot of trades. Here we've got 3 trades, a lot of take profit there, ladies and gentlemen, that you could have taken advantage of. Now you could have done this to this impulse wave as well, the continuation, because that's the 3rd. It's not the 4th or 5th or 6th or 7th, in which case, you know, you're running the risk of finding resistance. And you could have done that from the very first slide number 1. So crossover here, step number 1, we've got a bullish crossover. We're above the 75 bar exponential moving average. And if we look down here, we're approximately here. So we're not overbought like here. And by the way, ladies and gentlemen, if you do become overbought at some point, then ideally you will start to exit, regardless of the fact that if you've hit in the 125 or the 100 on the Fibonacci, because it's suddenly become overbought. You may, for example, say, I don't want it to be at 75, but if it goes to 76, 77, I'll start to close. If it's not overbought and you're hitting 125 though, you're still closing in line with the strategy. So here's step number 1. You can see we've got a signal to trade that 3rd impulse wave. What you would do, like we did here, very simply is at that line where you got the signal, we wait for the retracement. And as soon as it crosses over again, so at that point we'll enter the trade. Okay, this is option number 1. If it doesn't form a retracement, option number 2 is you can switch over from a 30 minutes, you can switch over to, for example, a 5 minute and trade the next impulse wave rather than, the next bullish crossover, rather than waiting for a retracement if the retracement doesn't form. And trade in the breakout. Instead of doing that, you can switch to 5 minutes, trade instead the bullish crossover on the 5 minutes. Then we go again to the 2 hour, and we want to trade this impulse wave here, ladies and gentlemen. We will draw the Fibonacci from the high here to the low here, and then these white lines will appear again. We would trade at the first breakout, like we said, on 30 minutes, on 5 minutes, the first bullish crossover, and then a second trade at the 50, a third trade at the 65. Take profit will be at, of course, the 100, and then a further take profit, for example, at 125. Keep in mind, because I can see while I'm speaking, I'm looking at the questions. Somebody says, how can I take advantage of the whole impulse wave? If you're going to look to take advantage of the whole wave, from the very first point to the very last point, you will be unsuccessful. Very simple. Okay, it's not something you should try and do. Because what you're basically saying to me is you have to be psychic to do something like that. I've never tried to trade the whole impulse wave from the very first pip to the last pip. Never will I. And if I did, I wouldn't be successful even after 10 years of experience. Let's answer some of these questions. What is the best Forex trading strategy? Here we're looking at Forex. So here we've moved away from gold and we're looking at the euro against the US dollar. This time I'm looking at a 3-hour time frame, which is also definitely appropriate. Again, like we said at the very beginning, the most appropriate time frames is the 2-hour, the 3-hour, and the 4-hour. For slightly longer term swing trading, so somebody that wants to keep it open for a week and above, so 1 to 2 weeks, and not look at 2, 3, 4 days, then they can look at, for example, the 6-hour as well. So to answer this question though, this is, for example, Euro USD, this is strategy, same strategy, but we're applying to currencies instead. So we want to trade the swing. We avoided this swing because it's the first swing, but I want to take advantage of this very large swing here, ladies and gentlemen. And we're going to look at how you can open multiple entries and exits along the way. So somebody says the default on the Fibonacci is the 61.8. Yes, that is correct. This is the default. Also keep in mind the default on the RSI is 14, but the default the period that we have here on the RSI, ladies and gentlemen, is actually 18. Keep that in mind. So very thank you, ladies, for the gentleman who asked this question, because also the RSI is on a period of 18. Not on the default of 14. In regards to the Fibonacci, yes, the default is at 61.8. You would have noticed a lot of those figures weren't the default parameters. So yes, we have changed the parameters. You also can change the parameters as well. For example, if an asset has a lot of volatility, they won't use 65, they probably will use 70. So keep in mind, what is the point of using the Fibonacci points? Because if you're looking, ladies and gentlemen, at the breakout, you're missing most of the price movement. So for example, if I'm looking at a breakout here, this will be the breakout point. Yes, I would have traded. The price moved in my favor. Was a great trade. Yes, okay. But based on here, the trend started here. I've entered at this line here and it exited and the trend ended here. So I've missed here approximately 60% of the impulse wave. So I've missed 60% of the swing when I'm trying to trade the swing. So it's an issue when you're trading the breakout. This is why we're looking at the Fibonacci. If it's not a very volatile asset, we can lower the parameter. So instead of looking at 61.8, we can look at, for example, 60. If it's very volatile, it's more appropriate to look at, for example, having a 68.00 or looking at 70.00, which still enters you before the breakout, so you get in a more competitive entry. Keep in mind, part of the swing approach is that we want to avoid those very predictable areas of the market. The breakout is definitely predictable, okay? So thank you for that question as well. Is there only moving averages we can use for swing trading? No, there's many different approaches and strategies to swing trade, and this is just one strategy. But you can only use technical analysis. If you're going to use, and there is benefits to also add in fundamental analysis, order flow analysis, sentimental analysis, but it will make up a small percentage of your analysis. But in terms of indicators, you can use many indicators, not only moving averages. For example, here we're using the RSI, we're using 3 moving averages, and we're also using breakouts, and we're also using price action and Fibonacci. So we're using those 5 things, right? It's not solely moving averages. Other strategies though may not use moving averages at all. So here, ladies and gentlemen, we're looking to trade the crossovers. So here we got an upward crossover, but it's a downward price movement. So I would avoid that first crossover. I do know we have a higher high here though. So it's 50-50 if you would take that into consideration. Some people would, some people wouldn't. But if not, then you can trade the next crossover, which is absolutely fine as well. But of course, somebody may have chosen to trade this because we're still looking at a higher low here. But some people may have said, you know, it's retracing. We're seeing lower lows and lower highs on multiple occasions, so maybe I won't trade that crossover. So you may or may not have. This though definitely is a signal, okay, because it's the second impulse wave within the swing, okay. So this is a crossover as well. So you can see the yellow's crossing over the red here, and we're above the 75 bar exponential moving average, and we're also above the 50 on the RSI. This, ladies and gentlemen, somebody may say this is also a signal, but it's not a signal. Now, why is this not a signal, ladies and gentlemen? There's a few reasons. Number one, because, ladies and gentlemen, we have a lower high, point number one. Point number two, we have a lower low. And more importantly, if we're looking at the RSI has a downward tilt. So this is divergence, ladies and gentlemen. So that is not a signal, even though we've got an upward crossover above the 75 bar exponential moving average. So what signal we're going to look to take advantage of? We're going to look to take advantage of this signal here. Okay, we're going to switch over to step number two. What are we going to do on step number two? Step number two, we're waiting for the retracement. The retracement happens, it falls approximately up to here, and then we trade the upward price movement again. So here we can see it starts to gain momentum. As soon as it crosses above here, we're going to look to trade the continuation of the swing. We still have volatility upwards and volatility downwards. It's not an issue. That is 100% part of swing trading, of course. Now, what we can do instead of what we previously looked at, what we can do instead to open multiple short-term entries rather than three more medium-term entries with 2 exits is we can switch over to a 1 hour time frame after getting that breakout, and after step number one where we get the crossover above the 75 bar and so on and so forth. We can then look at very simply we very simply can look thereafter at continued breakouts and continued crossovers. So for example, crossover here, we have a crossover here, and we were about to get a crossover here, but it hasn't actually taken place. Then we've got breakouts. So we have a breakout level here, and we have a breakout level here. So as soon as it breaks above this level, then we can trade the continuation of the trend. Simultaneously, of course, we always want it to be between 50 and 75 and not hovering around 50. So if it's above, but it's just hovering sideways above 50, then that's an issue as well. We want it to be very clearly above and moving upwards. Now, if we get a large retracement, then we can't use Fibonacci because it will give us our entry very low down. So for example, if we get an upward trend like this, and then we get a downward trend like this, even though it's a retracement because it hasn't gone to the previous low, we can't draw Fibonacci levels here. It will give us, at 65 or 61.8, or potentially if we put it higher, whatever it may be, we'll be entering here. But actually it may do something like this because it's a continuation of the downward trend. So if it's a larger retracement, we can't use the Fibonacci. But if it's a decent sized retracement, so for example, we've got a high here and we've got a low here retracement, we can use the Fibonacci, give us an entry, for example, approximately here to trade the continuation of the trend. So ladies and gentlemen, that brings us to the end of today's webinar. Now we had some questions if we can look at different strategies. Today though, because we've only got 1 hour, actually been speaking more than 1 hour, we of course will look at one strategy. Each webinar will look at different strategies. We will have more webinars on swing trading and on different strategies as well. This is a very well-known strategy. It's an easy strategy to follow as well. What is also massively important though is the reward to risk ratio. So reward to risk ratio and your success rate. Okay, because if you're looking at this strategy, and you personally, you may be trading in Euro USD, you're looking at this strategy, it may give you, for example, you may be opening 10 trades a month. You got a 70% success rate, for example, so it's not very high, but it's not low. So you've got 7 trades in a profit, 3 trades in a loss. You need to look at that and say, based on this, based on 7 trades in a profit, 7 trades that are closing in a loss, when I'm profiting, how much do I need to earn? And when I'm in a loss, in order for it to affect my profit, how much am I willing to risk to allow enough volatility in the market? And you know, if you say to yourself, I'm going to allow 50 pips, you have to go to the past trades and say, this is where I entered. This is where I would put my stop loss based on 50 pips. Would it have knocked me out of the market before the trend moved in my favor? If it doesn't, then you know, happy days, 50 pips, that's absolutely fine. If it's going to knock you out, then either your profit needs to change in order to change how much you're willing to risk, or the other way around. Okay, so this is something we need to definitely, you need to take into consideration while trading. The most important thing is not the strategy, it's your reward to risk ratio compared to your success rate. Saying to yourself, you know, I've got this success rate, so this is the reward to risk ratio that I need. This is how much I need to earn per trade and risk per trade for me to be profitable based on my success rate. Okay, so hopefully that was educational. Hopefully it was informative. If somebody has questions, feel free to ask now. More than happy to answer as many questions as people like. We will, in the meantime, also end with a poll, as we always do. Tomorrow evening, very late after 12 o'clock tomorrow, we will have NVIDIA's earnings. So there will be a lot of volatility for NVIDIA. NVIDIA approximately now is priced around $940. So the question is, after NVIDIA's earnings, will it soar and break above 1,000 US dollars? So this is a stock, NVIDIA, the most successful stock of 2023, so far also of 2024. Will it break $1,000 per share after its earnings data? So let's see what people have to vote. We only have 41% have voted. I want at least 60 people that are watching voting, and I will share what people answered so everybody can see what people are answering. Because people, of course, can take it into consideration for themselves as well. That this percentage of people that watch today's webinar and are trading with me on this platform believe that this is going to happen within the market. So we're almost at 60%, almost at 60%. Come on, guys, let's get the last vote in, and I'll share what everybody voted. It's very interesting. There we go. So we just got somebody voted. So we've gone to 60 now. Right. So let's end the poll. Everybody, we have, it was as I expected as well. We had 87% believe that NVIDIA will hit and move above 1,000 US dollars. And we have 13% believe they won't. So some people think that there's going to be a shock within the market. Some people think the upward trend will continue and it will break 1,000. Also keep in mind, NVIDIA over the past 12 months on every single occasion have beat their earnings data and have beat their expected earnings per share and have beat their expected revenue. So let's see if there's going to be something different in the market this time. And of course, we'll look at again what people voted compared to what actually happened on next week's webinar. So very quickly, if somebody has a question, feel free to answer now. I've got somebody raised his hand, but I don't have a question. So please answer a question for me to answer. Otherwise, we'll end the session. No, I can't see any questions. I can see most people are leaving. People saying thank you. Okay, so let's end the session. So trade safe, ladies and gentlemen, trade responsibly, and we'll speak again very, very soon. In the meantime, goodbye. I can see a question. Okay, so let me quickly answer the question as well. How does volatility change the overall outcome of the strategy? Very simple. The more volatility and stronger the trend, the more successful the strategy is. Why? Because the more accurate indicators are. To be honest though, this is the case 99% of the time with strategies, generally speaking. This is why I always say it's very important not solely to be looking at your strategy, but look at your success rate, your reward to risk ratio compared to your success rate, okay? Because somebody may have, for example, a very low success rate, okay? So maybe they're beginners, they don't have a great understanding of the market, maybe their strategy is not great. He may be trading 10 trades a week. He has a 30% success rate. So he's got 3 trades he's closed this week in a profit, 7 trades he closed in a loss. If he's earning per trade that he's earning and he's closing in a profit, for example, 125, and then he's losing and risking per trade that he closes in a loss, for example, 50, he's still in a profit. Why? Because he's got a loss by the end of the week of 350, and his profit is 375. So he's actually got a profit at the end of each week of $25. It's not a lot, but for somebody that has 30% success rate, which is very low, he is still profitable. Okay, so this is the main important thing. Don't get sucked into the bad habit of solely thinking the most important thing is the volatility and strategy. It's very important. It's very important, but it's not the most important thing. But that's how it affects the strategy. More volatility, the longer the direction, the stronger the direction, the more accurate the strategy is. If there's not, and it's just moving sideways, it's less accurate. And swing trading, generally speaking, is less accurate because it's looking at the swing. Okay, if it's very little volatility, just moving sideways, or a mean reversion price strategy, a price condition, then again, it's a difficult strategy to follow. So hopefully that answers the question. All right, let's end it there, ladies and gentlemen. Trade safe, trade responsibly, and we'll speak again very soon. On Wednesday, we will have a live, on Thursday, we will have a live webinar as well on YouTube and also on Twitter, where we will analyze the market live during an event, an economic event. So goodbye, ladies and gentlemen, and we'll speak again very soon towards the end of the week. Goodbye.